We've had a lot of important news for UK interest rate prospects recently. The new government with a radical agenda, really important economic data both here and abroad. Even the attempted assassination of Donald Trump affects the outlook. Now, the markets reckon that the odds that the Bank of England will cut base rates when they meet early next month, they put that at better than 50-50. And overall, they've priced in at least 2 rate cuts by year end. Now, I'm less optimistic than that in the near term, though it's notable that the international background has become more favourable rate cuts, and that contrast suggests that sterling strength will continue. Let me explain the reasons. Over in the US, the attack on Donald Trump seems to have further increased his chances of winning the election, even if the Democrats were to persuade Biden to stand down, which he shows no intentions of doing. Now, there are concerns that a Trump presidency could push up bond yields because of his tax-cutting agenda. He's also likely to raise revenue via higher tariffs, and the bigger effect may be to boost US equities. But in the near term, though, the Federal Reserve, they're going to be more focused on the recent data showing lower inflation and slower growth in the US economy. Now, US interest rate prospects do have a big effect on market pricing for rates in other countries, including here in the UK, but the Bank of England, they will be more focused on domestic factors, and these do suggest caution. First and foremost is the big improvement in UK GDP. That's hardly surprising in my opinion. It surprised lots of people, but inflation has fallen, real incomes and confidence are rising, and despite all the doom and gloom surrounding the outgoing government, business investment has actually been strong and set to increase further. And that background reduces the pressure on the Bank of England committee to cut rates. Now, I agree, inflation has hit the 2% target and looks set to stay there for the next few months, but an awful lot of that reflects base effects, not least from tumbling energy bills. And the Bank of England are concerned about the sustainability of that decline, given the very high level of wage inflation. Now, that was boosted by the 10% hike in the minimum wage in April, and that's clearly feeding through to wages more generally and the price of labour-intensive areas like services. Now, I do think wage inflation will fall here, but it starts from a very high base. And the new Labour government have already said they'll extend the minimum wage to young adults and are likely to push the overall level higher. There's also bad news to come on energy bills, with the Ofgem price cap set to rise by 12% in October. The budget, likely to be in November, well, that's going to stick to the inherited fiscal rules, but is likely to increase demand by increasing spending financed by higher capital taxes. That effect is likely to be more spending. At the last 2 meetings of the Bank of England Rate Setting Committee, 2 of the 9 members voted to cut. I reckon they'll remain in the minority at the next meeting on the 1st of August. Over in Europe, the economy there continues to stutter, and with inflation falling there too, that should open the way for further rate cuts from the European Central Bank. So, stable interest rates here with an improving economy versus slower rates and slower growth overseas, that looks like a good background for sterling to continue to strengthen. We shall see. May I end by congratulating Spain on beating England in Euro 24. I'm afraid to say the better team did seem to win. Until next week, goodbye.